Hello students, I have come up with a new topic today, that is retirement of a partner. In my previous video, I explained you about admission of a new partner. Admission means a new person is joining into your partnership firm. And one more 12-mark question, that is retirement unit. In this retirement, we are going to handle 12-mark question for PUC second year. So, I am taking one sample question to explain it clearly. Here in this example, I have taken Radha, Sheila and Meena are our partners. So, let's see this problem once. As I told you, whenever you have a balance sheet and this 12-mark question, read the question properly. Each and every line is important. So, before starting up a problem, read the problem carefully. Here we have Radha, Sheila and Meena were partners who are sharing profit and loss in 3:2:1. What does it means? If 3 plus 2 is 5, 5 plus 1 is 6. If total profit is 6 rupees, Radha is taking 3 rupees, Sheila is taking 2 rupees and Meena is taking 1 rupee. But on April 1st, 2018, Sheila retires from the firm. So, in partnership firm, there is no rule that the partner should continue forever. Anytime, any point of time, they can, if they are not interested or because of any other reason, old age, they can retire. So, here Sheila retires from the partnership firm. So, 3 partners were there, Radha, Sheila, Meena. But now, Sheila is going to retire. So, before retirement, what the partners will do, they will revalue all the assets and liabilities, and because of these assets and liabilities revaluing, whatever the changes, if it is benefit, they will share together. If it is loss, they will bear together. After that, they will prepare their capital accounts just to show whose amount is how much in the partnership firm. Means the investment will not be same forever. It will change because for the investment you have to add all profits, reserves and other changes. So whatever the changed capital we will show in capital accounts. In the retirement we will have 2 options. Suppose if you have sufficient money, if you means here the continuing partners in the firm, if they have sufficient money, they can repay Sheila's amount and they can say bye to Sheila. If they are not able to repay to Sheila, they can make it as a loan. Means till today, she was owner and one of the partner in the partnership firm, but from tomorrow onwards, she will become your creditor. Because of that reason, we will write in the balance sheet, Sheila, not in the capital heading, we'll write it as a separate heading, which is called as loan account of Sheila. So, let's continue our problem. So, balance sheet is given below. This balance sheet represent when Sheila also in the partnership firm, because this is old balance sheet. Now, with the help of this old balance sheet, you're going to prepare new balance sheet. But for preparing new balance sheet, you need to change some amounts. According to the changes, you have to show the current balances in the balance sheet. To represent proper and correct balance sheet, you need to prepare revaluation account as well as a capital accounts of partnership firm. Let's go for your old balance sheet. According to your old balance sheet, creditors were 3,000, bills payable 4,500, expenses owing 4,500. Means you need to pay some expenses, unpaid expenses 4,500. Reserve 13,500. As I told you in the previous video also, reserve is nothing but the profit percentage. Usually in the partnership firm or in a company also, the partners, they will not share all the profits. They will keep a small percentage aside because future is uncertain. If in the future, if you get any loss, you can survive with the help of this reserve. To face that loss or to decrease the burden or a risk of loss, today's profit you will keep aside some amount. So these 3 guys, Radha, Sheila, Meena, they saved 13,500 aside to face the future risk. and the investments are Radha is given as 15,000, Sheila is 15,000, Meena is 15,000. Altogether total investment is 45,000. But now Sheila is retiring, though this 15,000 she will take it off. Whether you are paying it or you are keeping it as a loan, let's see. In asset side, cash in hand is 1500, cash at bank is 7500. Means in your hand cash is 1500 rupees and in your bank account, all three will open bank account, in their bank balance 7500. So total cash with you is this 7500 as well as this 1500 also. Debtors amount 15,000, stock 12,000, factory premises 22,500. Machinery is given as 8,000, loose tools are 4,000. All these are assets according to your old balance sheet. After this table, you will get to see the terms or adjustments. So, before retirement, again you will evaluate goodwill also. As I told you earlier, when admission case, the new partner is going to bring goodwill to give old partners or the existing partners for their sacrificing profit for the new one. In case of retirement, you are revaluing goodwill again because by retirement of one partner, these two, the remaining continuing partners are going to get gain new ratio. Means till today they used to share 2:2, 3:2:1. Means out of 6 rupees profit, one is taking 3 rupees, one is taking 2 rupees and one is taking 1 rupee. But now this is gone. Sheila is going out. So the leftover profit is 3:1. So out of 4 only he is getting 3 rupees and out of 4 he is getting 1 rupee. So they gained because of the Sheila's retirement. So Sheila profit also now taken by Radha and Meena. Because they are gaining because of Sheila's retirement, they are going to compensate Sheila with goodwill. So total firm's goodwill is 13,500. Remember students, this is the value of total firm, not the value of Sheila. Sheila's goodwill will be again calculated on the basis of her profit sharing ratio. So this 13,500, whatever showing in the adjustment, is complete total partnership firm goodwill. So in this, Radha, Meena share will also be there. But you don't worry about Radha, Meena share because Sheila is only the person who is going out. So we will take care of Sheila's share only as of now. Expenses owing brought down to 3,750. Check in your balance sheet. Expenses were 4,500 rupees according to your old balance sheet. But it decreased to 3,750. Means your burden reduced. So your liability reduced, it is benefit for you. No need to pay 4,500 now because it is only 3,750. So it is profit benefit to you. Machinery value 10% less. 10% less means your machinery value according to balance sheet, it was 8,000. But it decreased 10%. Depreciation. Depreciation is always loss for you. So the value of asset is decreased. So it is loss for you. How much loss? 10% loss. It was 8,000 earlier. Out of 8,000, 10% loss. Means 800 loss for you. Factory premises revalued at 24,300. So when you valued now, the factory value was 24,300. Check in your old balance sheet. What was that value? Actually, the value was 22,500. So from 22,500, it increased to 24,300. Means your asset value increased. If your asset value is increasing, that is benefit or a profit for you. So whenever you are taking revaluation account, you need to consider all these assets and liabilities which are changed by revaluing. Don't go to all the assets and liabilities while preparing revaluation account. Remember this point students, you need to consider only adjustment assets, adjustment liabilities while preparing revaluation account. Only those changes you need to record in the revaluation. Because the main purpose of revaluation account is to find out how many assets or liabilities changed. Because of these value changes, whether we benefited or we got loss. We will find out by revaluation account. So whenever you are preparing revaluation account, keep it in your mind that you need to concentrate only on the adjustment assets and liabilities. That too changes only you need to record. Let's go for the revaluation account. Keep your problem in front of you so that we can write properly. First one is revaluation account. Before doing, I am explaining in a simple manner, keeping examination point of view. So this is revaluation account. In revaluation account, keep one point in your mind. If for you, if it is profit, record in credit side. If it is loss, record in debit side. Just check because of these changes, adjustment changes. If you are benefiting, credit that amount. If you are getting loss, record in the debit side. Let's go from second adjustment because this goodwill is related to capital account. No need to consider here. Expenses owing brought down to 3,750. How much expenses you have earlier in the balance sheet? 4,500. Now it reduced to 3,750. So what is the difference here? How much you gained? 750. So because expenses reduced, your balance sheet or a liability side amount reduced, your expenses came down. So you got profit here. So profits this side. Otherwise you can remember with this point also. If asset increased, profit. If liability decreased also, profit. By expenses owing. So previously 4,500 was your burden. Now it reduced to 3,750. So you have 750 difference in between balance sheet and adjustment amount. Second one, second adjustment, machinery value 10% less. 10% less means you had 8,000 value of machinery earlier. Now but it is decreased. Decreased asset means loss for you. Asset decreased, it will be loss for you. So how much loss? That loss only you have to show. You should not show whole value of machinery here. Remember this point. You have to show only the change. To machinery account, it was 8,000 earlier. How much reduced? 10% reduced. 10% means here 800 loss for you. Go for the next one. Factory premises revalued at 24,300. It was earlier 22,500. Now it is increased to 24,300. Means your asset value increased. When asset value increased, it will be gain for you. So factory premises now 24,300, but earlier it was 22,500. How much you gained because of this change? It will be 1,800 profit for you. Next, that's all. No other adjustments. That's all. So revaluation account is done. Check which side is more. Profits are more or losses are more. If we'll check, you will see your profits are more. Your asset or liability different 2,550. Whatever highest amount, write both the sides. Highest amount will be taken both the sides. Highest amount minus lowest amount. It will be this side, which is revaluation profit. Because your profits are more. How much revaluation profit? 2,550 minus 800. So this 1,750 you have to share to Radha, Sheila and Meena in the given ratio, which is 3:2:1. So let's share revaluation profit to all three. First one is Radha, which is 3/6 for Radha, and for Sheila it will be 2/6, and for Meena it will be 1/6. So share this 1,750 to all three. 3/6, which will comes to 875 for Radha and 583 for Sheila, 292 for Meena. After sharing revaluation account, let's move to capital accounts. Here in the capital accounts, remember only one point. Credit side, you will record all those amounts which are related to partners, which they are going to receive or which are their investment or amount in the firm. And debit side, whatever they are going to return back to the firm or we are going to deduct from their investment, that will be debit side. So always start capital account with by balance brought down. By balance brought down means in the old balance sheet, whatever their investments given in the old balance sheet, that amount will take in the brought down section. So for Radha's investment was 15,000, Sheila's also 15,000, Meena's also 15,000. This investment 15,000, it was for last year. This year again the investment value will change because there may be some additions and subtractions. Means if they are getting any profit, we will add to their investment. If the firm is taking anything from the partners or they are withdrawing anything from their investment, will write on the debit side. So let's start. What you will share. Always you will find reserve in your balance sheet, previous balance sheet. As I told you, reserve is a previous profit share which belongs to or which relate to all Radha, Sheila and Meena. You have to share that reserve in 3:2:1. So if you share reserve in 3:2:1 ratio, it will be 6,750, 4,500 and 2,250 for Meena. And what else? We got revaluation profit. By changing assets and liabilities value, we got some profits. So profits also will add to their investment. So revaluation profits. Revaluation profit, we shared 875 to Radha, 583 to Sheila, 292 to Meena. So these are the revaluation profits. Now move on to the important point, that is goodwill. Goodwill, see the adjustment of goodwill. Goodwill valued 13,500 and it is written off. So what is this goodwill? As I told you, goodwill is the extra profit which you gain because of your firm's good name. So your profits, extra profits are 13,500, which is write off all three partners. First, credit side, share equally to all partners. 13,500 by 3/6, 13,500 by 2/6, 13,500 by 1/6. This is a share for Radha, Sheila and Meena also. So the amounts will be 13,500 divided by 3/6 is equal to 6,750. It will be 4,500 and 2,250. So first credit side, simply will share goodwill to all three partners because this goodwill is related to all three partners. So 6,750 investment increased by adding goodwill, 4,500, 2,250. But it is mentioned that written off. Written off means whatever this 13,500 share is there, out of that Sheila's share is 4,500. So Sheila's share is 4,500, but it is given here, mentioned here in your adjustment means total goodwill is written off. So you are paying back total goodwill. So who is retiring here? Sheila. So this 13,500 you have to pay to Sheila while going. Why you are paying means here Radha and Meena are gaining profit sharing ratio. What is this gaining ratio means? Earlier they used to share 3:2:1. But Sheila is going. So her 2 rupees also shared by these leftover or continuing partners. So by retirement of Sheila, these 2 continuing partners are gaining her profit also. They can enjoy her profits also. Because of that reason, they will pay this goodwill according to their gaining ratio or gain ratio. So what is a gain ratio here? 3:2:1 is actual ratios. So Sheila gone now. So 3:1 will be gain ratio. 3:1 ratio they will share and give it to the retired partner Sheila. 13,500 into 3/4 gain ratio. How I got gain ratio here? 3:1. the gaining ratio. 3:1 means 3 plus 1 is 4. 3 by 4, 1 by 4. Whatever we are getting extra profit because of the retired partner, extra profit according to that new profit sharing ratio, this is gained or new profit sharing ratio. This is not actually gain ratio, it is new profit sharing ratio. According to new profit sharing ratio, they will share and compensate to the Sheila. So 13,500 into 3 by 4, 13,500 into 1 by 4. So we will deduct from their capital accounts and will pay it to Sheila now. How we are paying? Goodwill, we are returning off goodwill. So total 13,500 we are returning off. 10,125 you will get because of that sharing, and for Meena 3,375. So total 13,500 they are returning off. We are not showing again in the balance sheet written off because these two are gaining. We are sharing in the new profit sharing ratio. After that, the next one, after goodwill written off, just check any other profits or losses to be shared. Nothing is here. Goodwill also over. All these are revaluation account. Now check which side is more. Do the totals and check which side is more. Which side balance is more. So here Radha's total will be 29,375 and Sheila's share is 24,583 and last 19,792. So this is the highest, take both the sides. Now 29,375 minus 10,125. It will be by balance carried down. To balance carried down. So it will be 19,250 and for Meena it will be 16,470. But I am not taking in the carried down transaction Sheila's amount. Carried down means those who are continuing, for them we are writing carried down. But Sheila is not going to continue in the partnership form. So you have, whether you have to pay or you have to make it as a loan. It is in the problem nowhere mentioned we are paying to her. So we'll make it as a loan account. Sheila loan account. We are creating Sheila's loan account. How much you need to pay to Sheila? 24,583 rupees. This is, we are creating it as a loan. If in some cases, if you are paying in the form of cash, you need to deduct that cash which you are paying. Then the remaining leftover amount you have to show in the loan account. As of now, nothing is given in your problem. So carried down amounts will be for the continuing partners and loan account is for the retired partner. After capital accounts, we'll go for balance sheet. Whenever you're doing balance sheet, keep your old balance sheet in front of you. Because the balance sheet, on the basis of old balance sheet only, we are going to prepare new balance sheet by taking changes wherever needed. So first one is trade creditors. In trade creditors, nothing changed. It is same as it is. So no need to change any amount. You can take 3,000 directly. And bills payable 4,500. Now check expenses owing. This amount is changed if you remember our adjustment. Expenses owing brought down to 3,750. So it is not 4,500 now. It is 3,750. Reserve already we distributed to capital accounts. So there will not be any reserve. And capital account heading. In capital accounts, Radha is continuing in our business. Meena is also continuing in the firm. So you need to take only Radha and Meena in capital accounts because Sheila no more owner or a partner in your firm. She will be a creditor with you. So loan account will be Sheila's account. Don't take these amounts here because the new capital accounts we prepared and new capital balances are different now. So carried down amounts you have to take for the continuing partner. Loan account also this side amount. 19,250 for Radha. 19,250 for Radha and 16,417. 16,417 for Meena. The total will be 35,667. And Sheila's loan account also you need to take this amount 24,583. 24,583. Now go for asset side. Cash in hand, there is no change in cash in hand. We did not receive any cash or we did not pay any cash. So cash will remain same as it is right down. Cash at bank also no change. We did not withdraw anything or we did not deposit anything. So take it as it is. Debtors. Debtors also you have one bad debts. So you have check whether we have any bad debts. Bad debts, no bad debts for the debtors also. So you can take directly that amount. If you have any bad debts, you need to deduct the bad debts and take the remaining amount here, adjusted amount. Stock also nothing mentioned in the adjustment. Stock is also as it is 12,000. Factory premises amount changed. So that factory premises account you need to change, take new amount. New amount directly given 24,300. So I'm changing only amounts here. The remaining transactions are as it is. Machinery, it is said that machinery value decreased to 10,000. It was 8,000 earlier, 800 decreased, so it will be 7,200 now. Loose tools, nothing is mentioned for loose tools. So we should assume that the loose tools value remains same 4,000. Now check your adjustment whether you have anything else to write or not. Goodwill already we distributed, expenses also taken, machinery value also taken, factory premises also, revalued value only we are taken. So you need to total it. And in the balance sheet, as you know, you should get both the sides equally as we are following double entry system. So 71,500 this side and 71,500 liability side, both the sides same balances. So this is in case of retirement. In admission and retirement, you will find only a single change, that is mainly goodwill. If you work out with the goodwill, it is same as it is like admission. Revaluation account will be same. Only in capital accounts you need to handle goodwill. The balance sheet will also be same, but instead of capital account you will write the partner loan account. The partner, retired partners one loan account. If you are not paying, keeping it as a loan. You need to consider only that point. If you have any doubts regarding this retirement or if you want any other topic, just let me know in the comment section. Thank you.